Thank you everybody and for dialing in. This is the first event we're co-hosting at CIMA and Technology Business Group after the transition to the virtual learning environment. We're really excited to welcome Gavin Baker to this fireside chat. And what we'll do is to sort of have a moderated discussion for the first, call it 30 to 45 minutes, and open up for Q&A for everyone after. If I could just ask everyone to direct their questions over private message to Danielle, and she will be sort of moderating the Q&A section after. That would be great. Before we begin, I'd love to introduce Gavin as the founder and CIO of Atreides Management. Prior to founding Atreides in 2019, Gavin was at Fidelity Investments to 2017, and most recently as the portfolio manager of the Fidelity OTC portfolio. He also helped spearhead Fidelity's venture capital investing from 2013 to 2017. I came across Gavin, as I mentioned, during an Invest Like the Best podcast late last year, where he shared a lot of insights about technology and investing. His Twitter feed is also full of insights, and we encourage you all to follow him to learn more about his thoughts real time. We're really grateful to have him share his time and insight with respect to the markets, technology business landscape, especially so during the COVID-19 crisis. Gavin, thank you again for your time, and hope you're well and doing well with the social distancing at home.
Yeah, thanks, David, and thank you for all the kind words. That was a very nice introduction.
Of course, least we could do. So, obviously COVID-19 has been the topic of mind, and we'd love to talk about what we look like on the other side. But before we get there, I'd love to really just start with how and when did you realize this was going to be as bad as it is, and what did you do to get there, and what did you do to prepare?
Sure. So first, I should say I'm prone to conspiracy theories, and I've read all of Nicholas Nassim Taleb's books, so I'm kind of always looking for black swans. So I think that was an advantage, and I was certainly early to COVID, but I think I'm probably 1 for 15 on worrying about black swans. In other words, there've been a lot of things that I worried about that didn't happen. So I don't think if I was early to COVID, I don't think it's a sign of an unusual ability to forecast or anticipate black swans. It's more just, kind of even a broken clock is right once a day. I just have a proclivity for, I guess, worrying about things like this. But according to our trader, and I guess it's in one of the minutes of one of our investment team meetings, I said in January that I thought COVID could be the biggest black swan I'd seen in my career. And I would say that I think Twitter was actually super helpful to forming that view and being early to worry about it. There are a lot of people in the tech community in Twitter. I kind of think of myself, I follow finance Twitter, technology Twitter, venture capital Twitter, politics Twitter, and video game Twitter. There's kind of 5 distinct sub-Twitters that I follow. But I'd say technology and venture capital Twitter were very early to be worried about COVID. And then I just started to think about what China was doing relative to what they were saying. And it's one of the more extreme actions any government has ever taken during peacetime in the last 100 years. So I started to think about that. The market was at all-time highs. And then my birthday is February 21st. My wife's birthday is February 22nd. And the weekend of my birthday, we have a kind of a big joint birthday party, so we had a lot of friends in town. But the weekend of my birthday, for whatever reason, a lot of things just clicked. Someone on Twitter named Super Mugatu, whose real name is Dan McMurtry, had written a thread that was incredibly prescient. I think sometime, and he was one of the people in January and February who's very early to be worried about this. He runs a hedge fund that he started and founded called Tyro Capital Partners, I believe. he wrote a thread that really resonated with me on the risks from the coronavirus. And he actually recommended that I just see a couple of epidemiologists who are world class were saying on Twitter. And it's really amazing that weekend, and this is, I guess Scott Gottlieb is not an epidemiologist, but there's, I only know their Twitter handles, M. Lipschitz. I think it's Mark Lipschitz, who's an epidemiologist who runs a center at Harvard. Tommy Inglesby, who I believe runs the Center for Epidemiology at Johns Hopkins, and someone whose handle is Amesh AA. They all basically started saying, this is over. We are past containment. This is going to be a pandemic, and now we need to focus on mitigation. And that was incredible. And I looked at what they were saying relative to what was being discounted in the market. And then coincidentally, a good friend of mine who's a very prominent venture capitalist messaged me to say, hey, that they were seeing big supply chain disruptions, and he thought that it was going to be a really big deal. And then I'm lucky enough to be friends with an older gentleman who I think is one of the world's great macro investors, and we made a deal where he can always call me and ask me anything about technology, anything about growth stocks, and in return, he will just tell me whenever he gets worried. So he called me on Sunday and just said that he was worried, and so all those things kind of clicked. Yeah, I owe Twitter a lot. And I'm happy to give you loads of examples of all the other black swans I worried about that did not come to pass. So please don't think that I am at all unusually prescient with things like this.
So over the sort of course of this crisis, what surprised you the most?
Surprised me the most, and I alluded to it on Patrick's podcast, is the extent to which you got paid for doing really obvious things. Probably some point in the second week of March, you just thought, wow, hotels and cruise lines and casinos, and airlines, they just can't go down anymore. And at the same time, you thought, wow, Walmart, Kroger, Amazon, Netflix, the stay-at-home Zoom, the stay-at-home work-from-home beneficiaries, Clorox, they can't go up. And just long after it felt like it was super obvious, like that to me probably became super obvious sometime in the first week of March, if not sooner, you could generate almost a lifetime's worth. You could have generated a lifetime's worth of alpha by doing the most obvious thing imaginable, which was hard for me because I think as an investor, sorry if I'm repeating what some of the things I said on Patrick's podcast, you were really trained to never do obvious things, to assume that if it's obvious, it's discounted, and it just wasn't. And it was the crazy thing because that was the same observation I had in 0809. We're doing the really, really obvious thing, just selling all of your financials, really, really paid. I guess it's a lesson that I will have to learn more than once. That was by far the most surprising thing to me of everything in the market so far.
Right, and you sort of talked about the wide range of outcomes that we can possibly have. And so we've been really lucky to have a lot of investors come through and talk about what their views are on the markets. And the opinions range from this is the best buying opportunity in a generation to this is Armageddon. And can you maybe sort of talk about that in sort of relation to the idea that you sort of mentioned about how sensitive we are to initial conditions and in terms of how we come out the other end?
Yeah. I guess, I'm sure there are many paths to being a great investor. But for me, humility and kind of flexibility are really important. So I don't have a high conviction view. I think that this is a low conviction time with a really wide range of outcomes. And I'm trying not, I think one thing that's dangerous, one thing that I was nervous about before I started tweeting more, I almost worry that anytime you give an opinion, you become biased and less open-minded. So I'm trying to stay open to all possibilities. So I don't think this is a high conviction time. I mean, we can say that statistically, valuation spreads maybe 10 days ago reached levels that have only been seen during the Great Depression in 08, 09. So statistically, just as from a long, short opportunity set, you were literally at a, once in a 30-year environment. So, but a statistically rich opportunity set to me does not translate to having a really high conviction view on what's going to happen. And I think the reasons to be flexible and humble and recognize there are a wide range of outcomes are, first, this is unprecedented. In 08, 09, everybody could read The Forgotten Man by Amity Shlaes. Everybody read The Panic of 1907. You could read the Carmen Reinhardt book. There were analogs. In 2000, there had been lots of other bubbles before. Like that was just a really classic stock market bubble. And we have good records of the tulip bubble and the South Sea bubble and, a railroad bubble. So there were kind of roadmaps that we could use in 08, 09 and 2000. But nothing like this has ever happened before. We haven't had a global pandemic and a networked, social media, internet-driven economy. And the economy has never just stopped like this. So there is no historical analog that we can look to guide our thinking. And we don't know a lot about the virus right now. So I think when you put all of that together, we are in a time of high uncertainty, uncertainty versus risk. We just flat out don't know what the outcomes are. There are large numbers of unknown unknowns. So I am trying to be open to a lot of different scenarios and think about what I would do in each scenario. A snapback where everybody, maybe there's one scenario where, we've had more stimulus than has ever been applied to the economy in history, and more stimulus applied in a faster, more concentrated, and I would argue probably more intelligent way than I've ever seen, both monetary and fiscal. So if it turns out that warm weather is going to really slow this virus down and America goes back to work, wow, there could be, the snapback rally of all snapback rallies, and it makes what we've seen seem like nothing. On the other hand, the virus looks like it is currently mutating at 1/3 the rate of the flu. If that rate of mutation accelerates, if warm weather doesn't slow it down, warm weather will slow it down because it's aerosol borne, and it's just a matter of physics that droplets travel less far in humid weather. But if we don't have improved treatments, if ultraviolet radiation doesn't kill the virus, if it comes back really quickly as soon as we relax social distancing, then we could be in for a much more dire scenario where we really need to wait till a vaccine, which is probably going to be 15 to 21 months away. So I think this is a time for humility and flexibility, not conviction. I am happy to have conviction on earnings power and free cash flow generation power for companies looking out 5 to 7 years and invest based upon that. But that goes to those long, short, valuation spread opportunities, as opposed to having a really high conviction view on something where we have no historical analogs and we still don't have a lot of important information. That feels better to me. But there are many paths. Many paths to investing success, and everybody has to find what works for them.
Right. And so maybe to follow up on that, what are some of the key signposts you're looking for to inform you of which one of these many iterations and paths we could take?
Sure. Well, so a few things. I've talked a lot internally about how this was a three-body problem in late February, in early March. That Chinese science fiction series is one of my all-time favorite works of science fiction. And a three-body problem just means that you have three planetary bodies exerting gravitational influences on each other, and there's no way to model it. Although I do have a good friend who is very good at physics who assures me that that is true. Although then I look it up on Wikipedia, and apparently it is a classic physics problem. But anyways, we had a three-body problem in late February, early March with politics, the virus, and the economy. And I was very worried, and this is not meant to be a political statement at all, but I think most people can agree that a Sanders presidency would not have been positive for the US or global stock markets. Maybe it would have been great for the world and America. Who knows? But it would not have been good for markets, particularly at the beginning. So I was very worried about the interaction of the virus, the economy, and presidential politics. And I thought there was a scenario where Sanders could easily be the nominee. And then we had Super Tuesday, and that kind of eliminated the political risk. And so now we have a two-body problem. And I think at one level, in some ways, maybe the most important thing we need to have happen in the near term is new cases of the virus to durably peak. We've had an enormous rally in the market over the last week. And that's basically the fact that it looks like cases in the Northeast of the United States and the West Coast of the United States have peaked. I'm sure everybody's seen the charts on hospitalizations and ICU utilization just collapsing in New York City, new cases rolling over. And the stock market is, it sounds very strange, but the stock market is always unusually sensitive to events in New York City because so many people who set prices live there. On the other hand, new cases in kind of the interior and south of the United States are still accelerating. And I would say one thing that is a little concerning is the degree to which new cases come back. In Singapore, once you relax social distancing, and a region of China is already in its second lockdown. But I think we do need new cases to peak or much better treatment regimens. And it is a lot of clinical trials are going to read out over the next kind of 4 to 6 weeks. And if those treatment regimens really impact the mortality rate of the virus, then new cases matter less. But we do need to go from, a two-body problem now, the virus, down to a one-body problem, which is just the market and the economy. And there, everybody has different checklists. I have kind of a different I have my own checklist for a bear market, having lived through 6 of them. You want valuation to compress. We've certainly seen that. You need a lot of stimulus. We've seen massive stimulus. The VIX needs to go down. Volatility has to abate. Markets just cannot bottom with the VIX at historically high levels. You need positioning to be cleaned up, whether it's gross leverage, net, whether it's cash, put call ratios. Positioning and sentiment needs to improve. Market internals always consistently improve. This is just cyclicals versus defensives, value versus growth, small versus large caps. And we have certainly seen that in the last week. Anything you could imagine, we've had historic levels of outperformance for 3 to 4 days for, kind of a variety of factors. But the big missing factor is realistic numbers from companies. I think in a world where so much of investing and trading is done quantitatively, it is hard to get a true market price until companies give guidance, because the algorithms do heavily depend on forward-looking numbers. I thought it was very interesting. Rich Bernstein was interviewed in Barron's, I believe last Saturday. Rich Bernstein wrote one of the all-time, a great book about investing called Style Investing, which left a lasting impression on me. But he basically said, I run money quantitatively, and we're on the sidelines until companies give guidance, because our models won't know what to do until we have accurate forward numbers. So I think we will get a true market price when companies begin reporting and guiding. And so far, all they've been doing is saying, hey, here's what happened in the last 2 weeks of March. They haven't actually given guidance. And the sell side has not probably taken, some people on the sell side have, come out with very brave forecasts that are, highly likely some of those will be right. But I think by and large, the sell side is waiting for companies to give guidance, just because you don't want to take a really strong stance and be horribly wrong. If you're in equity research, if you're in sell-side equity research, it's not to say there are people who've done great work and have come out with really non-consensus views, but do you really want to be the person to make a call on the virus and when the shutdown's going to be in because that's actually what's going to drive the second quarter, whether it's down 90, 70, 60, or 30? Do you really, if so I don't think the market has accurate numbers yet. So that's the last thing the market needs. And then I've been thinking a lot about how markets bottom and just kind of experiencing it in real time. And at some level, markets bottoming is just a process of rebuilding loss aversion. It goes back to prospect theory and regret minimization. And now there's all these stocks that are up 100 to 200% off the lows. Everybody, all professional investors, they feel intense regret that they didn't pull the trigger at the low. And so that is how markets bottom, because it's generally a process, and you generally have kind of bear market rallies, and then you have retests, and it's a process. That's how markets bottom. It gets back there, and you're like, wow, I'm so regretful that I didn't buy it. And I'm already beginning to feel, maybe at some level, my own internal loss aversion shift from, gosh, I'm really upset I didn't sell that at this price, to, wow, I'm really upset I didn't buy this at that price. But anyways, those are kind of some of the things I'm looking for, David.
Oh, that's great. And we'll get to sort of the decision-making things later, but maybe sort of switching gears a bit to the other side of this. So we clearly have some industries that are highly, highly impacted, but maybe focusing on technology. We all saw the Airbnb release of the paper they raised. So how does the technology industry look like on the other end? How does this shakeout sort of reset the playing field? And is it beneficial to incumbents, or is it actually beneficial to startups?
I think it is most beneficial to companies that have decisive CEOs. And I talked about this on Patrick's podcast, but I love all things fantasy and science fiction. I read Game of Thrones, I believe, for the first time more than 20 years ago. It was when I was in college, and I would reread the entire series every time a new book came out. But I did talk about this summer versus winter analogy, and in Game of Thrones, the knights of summer are very different from the knights of winter. The kings of summer are very different from the kings of winter. The queens of summer are very different from the queens of winter. And I think we're going to see who is a summer CEO and who is a winter CEO. The last 10 years have been very unusual, because in some way, almost everything that happened in technology over the last 10 years is a result of two really kind of foundational innovations. One is the iPhone, which was launched in 2009, and that was a location-aware, presence-aware, identity-aware supercomputer that was in everyone's pocket all the time, gathering all sorts of data about the world, both visual and audio, and connected to cloud computing, because cloud computing was also really kind of invented around the same time. It used to be called utility computing. I think the first, we have some people on here who are going to go work at Google, but I believe it's Urs Hosley who kind of ran infrastructure at Google, and the first YouTube videos of him talking about utility computing and cloud computing are from 2009 and 2010, and that's where Google, who really at some level, even probably more so than Amazon, invented cloud computing, started to talk about planetary scale computing. And then you could put all the data from these smartphones, process it in the cloud, and that revitalized artificial intelligence because all AI was missing. All of AI has been driven by very old algorithms. Maybe there's been a little bit of algorithmic innovation over the last 5 years, but basically all the old algorithms worked. They just needed way more data than anyone realized and way more computing power than anyone realized. But so you had those three kind of connected technological revolutions with the cloud and the iPhone really kicking things off in kind of 2009 that almost exactly coincided with kind of the bottom in the market and the bottom of an economic cycle. So, there's all these apps that were built off the iPhone: Uber, Airbnb, DoorDash, huge numbers of apps, and great companies that were built off the iPhone. You have this huge, all of SaaS was basically, these second and third generation SaaS companies were built, on top of AWS or GCP. And so you have these CEOs who in some cases now are running 30, 50, $60 billion kind of market cap companies who've actually never gone through a recession, who've never gone through a hard time economically. So nothing like this has ever happened before. Generally, you have a recession, I don't know, every 5 to 10 years, and it's not that often that they line up perfectly with such a huge technological discontinuity as the iPhone. You always read, oh wow, great companies are kind of born in darkness and during difficult times, but more companies than ever were born in 08, 09, and that's just because or 09 and 2010, it's just because that's when the iPhone happened to be invented. Generally, the reason great companies are kind of born in dark economic times is because that works to the favor of the best ideas and the best entrepreneurs. Only the best could get funding in 02, 03, 04. Who was able to go public in 03 and 04? 3 little tech companies called Google, Netflix, and Salesforce. So only the best of the best can get funded in a tough environment. But that was really amplified in 09 and 10 because you had this huge discontinuity during a dark economic time, and now we've had an unusually long expansion at 10 years. So I think it may be that a lot of these technology companies that are 10 or 11 years old are run by summer CEOs who can't make tough decisions. And so I would say the companies that are going to be most advantaged are the companies that are decisive and early. So that would be kind of my first order answer to your question, David, and happy to talk through different industries and
yeah, would love to sort of hear your thoughts on the video gaming industry because I know that's something you spend a bit of time on.
Yeah, so I play games the way a lot of my peers play golf. I'm not super into sports, but I do love playing video games. And they've been very real for me, and they particularly kind of probably more got really back into them. I always had so long ago in the year 2000, it's actually a very funny story. In the year 2000, I was the NVIDIA analyst at Fidelity, and what NVIDIA really had going for it in 2000, and stock went up 200% as the NASDAQ went down 80%, but their chip had been designed into the Xbox. The first Xbox, it all said powered by NVIDIA on the outside of it. And that was it was really important to kind of, NVIDIA becoming the company they are today, although there are lots of things there. Jensen, the CEO there, is absolutely top 5 technology CEO of all time. Another little aside is most semiconductor CEOs, CFOs, and COOs have owned stock and gotten hugely wealthy by owning stock in NVIDIA for the last 20 years because they've always been like, hey, I just want to bet on Jensen. He is exceptional. So anyways, I don't mean to say NVIDIA was all about the Xbox, but I had not played video games until then, and I was like, hey, I need to actually understand if the Xbox or the PlayStation is a better platform. So I set them up in the set them up in a conference room at Fidelity, and I'm sure, well, I will. I have thought better of telling the story, but let's just say that a very senior executive walked by late at night at 9 p.m. And I was playing video games. And she's like, "Well, what are you doing here playing video games in this, kind of open conference room?" And I was like, "Oh, I'm seeing if the Xbox or the PlayStation is better. Like, hey, would you come in and tell me which one you think the graphics are better on?" Anyways, and she came in and then we played video games for a while together. But so that got me back into video games, and then I covered a bunch of different industries that kind of always touched on video games in one shape or another. So I would always go to E3, and I always felt like it was a big advantage investing-wise to actually play the games. I sometimes say that imagine a world in which there's a bunch of retail investors, and most of them have never been to a store. They've actually never been to Amazon.com. All they'll do is sometimes they'll watch videos of other people walking through stores and shopping on Amazon. That is what investing in video games is like. The vast majority of professional investors, because in some ways I think one of the biggest class divides in America today is high-income people, by and large, don't play video games, and investors are by and large high-income people. So very few people who invest in games actually play them. So I think it's a big advantage. I would say beginning something that really changed the way I thought about video games. There's been an idea for a long time that we were going to have a metaverse. This is in Snow Crash. It's in Ready Player One. It's called the Oasis in Ready Player One if you've read the book or you've seen the movie. But just that a lot of people were going to spend a majority of their time in virtual worlds, which kind of from a first principles perspective makes a lot of sense. If you just think about Moore's law and the rate at which, kind of graphics power is compounding, at some point we're going to get to a point where virtual worlds are indistinguishable from the real world. And then eventually you're going to have brain-computer interfaces, and even from smell and touch, everything is going to be indistinguishable from the real world. So this has kind of been a big idea in science fiction for a long time, one that I thought was very logical from a first principles perspective. And so kind of was always fascinated by this idea. And by the way, that same principle is why so many people in technology and physics believe in simulation theory, but we won't go down that rabbit hole. Simulation theory, meaning just we're living in a simulation rather than a real world, which is actually shockingly difficult to disprove. But so I had always been kind of fascinated with this idea of the metaverse and the Oasis. And then, and this is, I think, very consensus thinking in Silicon Valley. When you hear Mark Zuckerberg say he wants to own the next platform, this is what he's talking about. The metaverse, the Oasis, whatever you're going to call it. This is why they bought Oculus. This is why they bought the BCI company. This is why Google and everyone is so focused, why Microsoft bought Minecraft. This is why all the big platform players are so focused on augmented reality, virtual reality. There's a thought that, if you can own the identity in the payments layer, you can own the avatar store. But then something happened watching, and I'm embarrassed that I didn't think of this first, because playing video games, I can tell you they are social networks. They're not hit-driven businesses. You play games with your friends, and it's really hard to get all your friends to play a new game. And some of the most, some of my best friends are people I only know them by their gamer tag, and maybe I know that they live in England and they work the night shift at a warehouse, but that's all I know about them. In terms of kind of a real world identity perspective. But so I always thought games were social networks, but then when Marshmello had that concert in Fortnite, kind of everything really clicked for me. And it was just, wow, video games are going to be the platform for the personal metaverse. The personal metaverse, forget about the professional metaverse, but the personal metaverse, I think in 20 to 30 years, at the end of this, I will be able to close my eyes and pilot a starship through a nebula or close my eyes and walk the streets of ancient Rome, close my eyes, have a, climb to the top of Mount Everest. Um, and then the augmented reality part of the metaverse, nobody's going to be able to lie. Like we're all going to have, this is going to become, the kind of edge server powering personal AI and ambient computing. And you're not going to be able to lie because if I'm talking to someone, my onboard AI will in real time be analyzing their skin temperature, their perspiration, their micro expressions, their pulse, and it will become impolite. You won't be able to have a real conversation with someone while you're wearing your AR glasses. But anyways, it just became really obvious to me as soon as I saw that Marshmallow concert in Fortnite that, wow, video games are social networks. They are going to be the platforms for the personal metaverse. The Assassin's Creed franchise, it is going to dominate the historic metaverse. And you're already seeing this. At the request of educators, they made what they called an explorer mode for Assassin's Creed Origins and Assassin's Creed Odyssey. So, because it's a great way for kids to learn about ancient Greece and ancient Egypt. We can speculate who's going to dominate kind of the military metaverse. Bobby Kotick, the CEO of Activision, another truly great executive, once told me that video games just fulfill universal fantasies, soldier fantasies, rock star fantasies, athlete fantasies, living in a different time fantasy, living in a different world fantasy, living in the future fantasy, living in the past fantasy. So these video games that already exist today with all the players built in, the social networks built in, they are going to be kind of the foundational platform layer for the personal metaverse. And I think one of the most ironic things is, Zuckerberg has been all over this for a long time, and Zuckerberg is another truly great CEO. But, if you read the memo that leaked in 2015, 2016, advocating for why, the pros and cons of buying Unity, it was fascinating. He was so focused on the infrastructure layer, the tooling, because what becomes a platform is something that becomes an abstraction layer and other apps are written to it. And I just think because he clearly did not personally play video games, it's almost like Mark Zuckerberg was not nerdy enough to appreciate this. And in some ways, Epic with Fortnite is one of the more strategic assets in all of video gaming and all of technology. And that was before House Party blew up. But I think it's endlessly ironic. Zuckerberg, he bought Oculus, which I don't think is going to end up being that important as a platform for the personal metaverse. But it's just endlessly ironic to me that Mark Zuckerberg, who often gets caricatured as being a nerdy guy, he's actually extremely engaging in person, was not nerdy enough to understand that video games would be the platform for the personal metaverse.
So on that sort of metaverse construct of video games, who are going to be, in your mind, the winners here? Are they going to be the existing developers like Activision, or are they, the distributors, or in that the current landscape?
I think both. I think that so a couple of things. I think for sure the developers, the people who own the IP, will be winners. I think the platforms, Xbox, Sony, Steam, now the Epic Store, are likely to be winners, but I think it's I have less confidence about that than I do about the underlying content owners. And the reason is a lot has been written about what the rise of cloud gaming, where you can stream a game the way you can stream a movie, is going to do to the industry. And a lot of people have conflated a technological delivery mechanism, streaming, with a business model, and that's just because of Spotify and Netflix. Content is always king. The reason content wasn't king to begin with music and movies and TV, is there's such a long tail. There's billions of songs, billions of movie and TV episodes. There's such a long tail. And you could combine that long tail of content that wasn't at all valuable before Netflix, Spotify, streaming, with really sophisticated algorithms to figure out that, oh, if you like Madonna, which is head content, here's 7 other artists that you've never heard of that you're probably going to like. And really increase the value of that long tail, deliver it in a subscription. And that created immense value for Spotify and Netflix. But it does not necessarily follow that streaming and subscriptions, go together like peanut butter and jelly. And with video games, a lot of people looked at cloud gaming, Google Stadia, and thought, oh, wow, this is going to be just like Netflix. Not at all, because there is not the same long tail of content in video games. The degree to which the top 10 video games utterly dominate engagement day in and day out is nothing like music or movies. So the underlying content owners, the owner of the historic metaverse, the soldier metaverse, the science fiction metaverse, the fantasy metaverse, the action adventure metaverse, they have way more leverage. And all of these new distribution options are only increasing their leverage. Now, it is, I think it was interesting the degree to which Google Stadia scared Sony, and to a lesser degree Microsoft, that they basically said, hey, we're going to share infrastructure. But I think the fact that the Sony cloud streaming service and Microsoft are both going to run on Azure means that probably technically they will be at parity with with Google. And then the fact that they have all the existing relationships, they already have all the content. If you're a gamer, you can just port your library there. Your friends list is there. So I am reasonably optimistic on the existing gaming platforms in addition to the publishers. But I think the publishers are kind of, to me, the simplest first order winner in this metaverse thesis.
Great. And before we open it up to the Q&A, just one last question for me is, you've mentioned sort of you want to be at the top 1% of knowledge in a particular industry. So fast forward 5 to 10 years, how do we know, or how do we assess ourselves in that landscape? And regardless if it's investing, technology, whatever we do, how do we sort of get to that, or how do we know we got there?
I would quote someone on Twitter. This was pretty controversial, kind of when I said it on Patrick's first podcast. But somebody on Twitter, a journalist for Bloomberg now, Take Him, actually just said, "When you know, you know." And I would say it takes a long time. We've all, the 10,000 hours rule. It takes a long time to achieve kind of true mastery in top 1%, and it's a very competitive world. So I would never be able to look at a stock or an industry for 3 years or 5 years and think, wow, I'm in the top 1%. It really takes a long time. I wrote an article on Medium talking about the Investing in the Name of the Rose, which is a great book. At some level, it's about the search for truth, which I think investing is all about, is ultimately the search for truth, and finding an investment style or philosophy that meshes with your emotional makeup such that you can kind of find truth and seek it. But I wrote a lot more in that if anybody wants to read it. But after 10, 12 years, you do just start to know. And then it is a little bit, what I probably should have said on the Patrick's first podcast, so I didn't come across as arrogant, is like, I have been doing this at 20 years for longer than almost all other public equity investors in tech. So many people walked away or were washed out with the bubble. So many people walked away or washed out 08, 09. There's more people who've been doing tech for 10 years than any other sector, but far fewer who've been doing it for 20 years. Tech is, probably second in complexity only to healthcare, specifically therapeutics and biotech, where cumulative knowledge, accumulating advantage, like just the years and the miles, they really matter, and there's no substitute for them. But I wish I could give you a metric, but I think kind of, but it's also really important to not think you're in the top 1% when you are not. So you always have to stay humble and kind of pressure test, because the most dangerous situation of all is you thinking that you're in the top 1% and you're actually not in the top 50%. That's how you lose vast amounts of money. And that goes to the importance of, and this is also kind of a lot of it is kind of woven through the book The Name Rose, which is by Umberto Eco, one of my favorite authors. But just you always have to balance conviction and flexibility when you are searching for truth. He is kind of searching for truth, I think, in a religious and philosophical way. The hero of that, William of Baskerville, and then he's searching for truth in being a detective and trying to unravel kind of a murder mystery in another. But in both of those, you have to balance conviction and flexibility. And investing is the same way. And you always have to, even in sector, even in an area where you're in the top 1% or the top 10 basis points of knowledge, you have to always be balancing conviction and flexibility as you kind of search for truth.
Great. And on that Dunning-Kruger effect note, I'll pass it over to Danielle to moderate the Q&A. Thank you again, Gavin, and we look forward to everybody's questions. Again, please.
Thanks, David. Great job.
Thank you. Please, first time doing this, so please send your questions to Danielle and she will moderate the Q&A segment.
Great, thank you. So given social distancing, we have quite a few questions on TikTok, two particular from Ronald and John. So Gavin, how do you see TikTok growing bigger in coming years? And how do you think they can change the landscape of the tech world?
I think it might be one of the most important things happening in the world of technology today. I've invested in large internet companies for many years, so really had been following TikTok for a long time. And, there's obviously a thesis that it was, it might be disruptive to current social networks. There's another thesis that every generation is going to have its own social network because nobody wants to be on the same social network as their parents. Snapchat, the fact that it's hard to use for a lot of people, is a feature, not a bug. And so maybe it's kind of like Snapchat was kind of the social network for millennials. Maybe TikTok will be the social network for kind of teenagers today. And there's a lot of kind of first principles differences between TikTok and other social networks. One, it's purely algorithmic. It's totally meritocratic in the way no other social network is. It's not based on popularity. Just look, I guess if Kim Kardashian posts something on TikTok, it's highly likely to go viral. But if another celebrity posts something that doesn't go viral, but somebody who's totally unknown posts something that begins to go viral, the algorithms will catch it. So it's a meritocratic, algorithmic social network in a very new way. It also hides likes because it's not hides likes. Likes are not important, because it is algorithmic. You don't have this phenomenon of, taking down an Instagram post if it's not at 75 likes in 15 minutes or whatever, everybody's filter is. Mine is I take down a post if I'm not at 3 likes after, a year. I've actually never taken down a post, but obviously a lot of people, are very sensitive to likes. So it's like Snapchat in that way a little bit. You don't have to create I think in some ways one of the most innovative things they did from a business model perspective was you don't have to sign on. You don't have to be a registered user to consume all of the content, which just took out so much friction. And it's something that I think some of the big American internet companies like Twitter are closely watching. But so was always watching it, but ultimately you have to be guided by the data. I was open to the possibility, but you did begin to see Instagram slow down in a very significant way in February. Now, everything in coronavirus, what's happened with coronavirus and working from home, I think makes the March data a little bit noisy. But, it's kind of like TikTok to me was a big threat. Everybody was worried about it. And then often in markets, people, it's like everybody knows there's a wolf outside. and gets so worried about it and writes about it and thinks about it, and then kind of forgets about it, and then the wolf actually does finally come inside the door, like the risk finally materializes. So all this work had been done on TikTok and its potential impact, but you kept looking at the data and no impact, no impact, no impact, and then boom, big impact in February. In a lot of measurable ways on Instagram. And I think that's probably been lost a little bit in coronavirus. But yeah, TikTok, as a tech investor, it's really important to stay young, to stay open-minded, be open to new ideas, IPOs. And a lot of times things that seem, kind of like silly little toys end up changing the world. Facebook started out as a site for college students to rate each other's attractiveness. Netflix, started out as a way to avoid DVD rental fees. So you kind of have to be very open-minded and really be open to things like TikTok, which, when it first started, maybe seemed a little silly, seemed a little bit like a toy. But some of these things end up really changing the world. And it's one reason, So I've tried to be very open to TikTok, even though personally it doesn't appeal to me. But I try to be open-minded. We joke at the office. Some of the people at the office joke we're going to make a TikTok. We'll see as part of this. But yeah, TikTok I think is one of the most fascinating things happening in technology right now.
I think moving from, I guess, one of our newer companies, TikTok, to thinking about, Raul wants us to think about our non-stay-at-home tech companies, CEOs, such as Expedia, Uber, Airbnb. And what steps, in your opinion, can the CEOs take to boost their cash positions in light of the demand decline and expectations of limited spending by users in the near future?
Yeah, the earlier you cut expenses, the less expenses you have to cut, because this is an area under the curve problem. So if you cut early, you have a shallower curve and you preserve more cash. If you cut late, you end up having to cut a lot deeper because you have to get to the same area under the curve. And one thing I'd just like to pause on, you guys are all going to be investors. I think it's really important to acknowledge when you say cut expenses, you're actually talking about firing people. And you're talking about firing people who are real people. They have real hopes and dreams. They have real families. They have real financial obligations. I hear a lot of investors bandy around, cut expenses, and like it's kind of some, like you're just closing an office or you're cutting travel. At the end of the day, people are the biggest expense for almost every business. So when you say companies need to cut expenses, you were talking about firing people. And that is a really hard thing to do. And I would just encourage everybody for your careers, to always keep that in mind, because you will be talking to CEOs and CFOs. And I promise you, if you are not, just in being a good human being, recognize what cutting expenses is and never say it lightly or casually, but B, understand that you're not going to have to do that. And when you're telling a CEO or a CFO to do that, you're telling them to fire people that he knows, people that he likes, people that she likes. And that's a really hard thing to do, so just be sensitive about it. But, sorry for saying that. It just always really frosts me when, I see, some investor, beating a CEO up for not cutting expenses more, acting like it's easy. It's a really hard thing to do. But it is something that has to be done, and, the good of the many outweighs the good of the one. I always think about that awesome scene at the end of Star Trek: The Wrath of Khan, between Kirk and Spock. I won't go into it, but basically Spock sacrifices himself to save the Enterprise. And if you don't cut expenses, the company may go to zero and you're going to fire everyone. So you have to do it. And good CEOs, winter CEOs, cut early, whereas the bad CEOs cut late. And then not only do you have to fire more people, but you are firing those people into the depths of the recession. if your company cuts expenses early, your odds of getting a job are so much higher than if your company cuts expenses later. So in addition to you owing it as a CEO to make hard decisions, because at the end of the day, you have to think about all the employees, not just the people who are losing their jobs. Um, it is a compassionate thing to do because it is going to happen at one point or another. It will happen. And it's just much more compassionate to do it earlier. And it is the right thing for the business. So those are all the reasons, it's the right thing morally. You have to cut fewer expenses, which means you're firing less people. You're letting them go into a stronger economy where they have better odds of finding a job. But because you cut less, because you cut early, you don't have to cut muscle. So then you come out of the recession in a stronger position. So I think those companies, they are all going through, they're going through winter, like a severe winter. And because nobody knows exactly what's going to happen with the virus, they don't know how long it's going to last. Booking just said yesterday that their revenue was down 85%. And they might run out of cash in 2021. The stock went up. I actually thought Bill Gurley had a great tweet about it. For anyone who thinks the stock market is really short-term focused, like here's an object lesson. It's actually very long-term focused. But yeah, those companies and those CEOs are going to have to do hard things. There's a lot of there are a lot of decisions that a lot of companies need to make. And we're going to see who's a summer CEO and who's a winter CEO.
And just sorry to jump in real quick here, but do you feel that's widely appreciated by CEOs right now?
Well, if you've been through a recession, it is, but that's why we're living through such a unique time where you have so many CEOs of so many big companies who've never, in some cases, they weren't even an adult during the last recession, or they were in, college, or they were in grad school. So it's a very unique time, and I think we are going to really sort the winners from the losers, and it is who is decisive, who is a winter CEO, who can do hard things. A mentor of mine, who's a mentor and really good friend of mine. His first name starts with an A, but he is a very private person. He likes to say, hard people build great companies. Steve Jobs, Jeff Bezos, Bill Gates, they were all really hard. They made a lot of hard decisions. In their own ways, they were all ruthless. So we're going to see who's a summer CEO, who's a winter CEO. And strangely enough, you would much rather be at a company run by a winter CEO. Because if you're an employee at a company run by a summer CEO, A, the company might not survive. B, chances are you are going to get fired along with a lot more people at the worst possible time. Because your CEO is a summer CEO and can't make difficult decisions. And I think it's particularly dangerous, this is the last thing I'll say. Not only do you have a lot of CEOs who have never been through a recession and are running huge companies, so don't have the experience they need, but you have CEOs who are in that position and are effectively post-economic because they've sold hundreds of millions of dollars worth of secondary. So actually what they care about now is their reputation and getting lionized in articles on TechCrunch in the New York Times. And they're not willing to make these tough decisions because they don't care about money. They don't care about the value of their company. They do a little bit only insofar as it impacts their reputation. But I think you put all that together and it's a very dangerous kind of triangle for some of these really big unicorns run by post-economic CEOs.
Definitely agreed. And given the last question about Uber indirectly. We have a question from Ming Ming about VC and private funding that has kind of quickly come into the industry in areas such as, food delivery and shared economy. And, do you think that there's a sustainable competitive advantage in these tech companies that have huge scale, but they operate in industries with really low barriers to entry?
For sure. So one of the strange things about the internet is barriers to entry are very low, but barriers to scale are really high. And because we're in such a bull market for so long, and marketplaces are great businesses. After search, they're probably the best businesses in the world, where you're just taking a cut of transactions that happen on the marketplace, on the platform. Bill Gurley wrote a great blog post about this. Everybody, if you are at all interested in technology, venture, investing, anything, everybody should read every blog post Bill Gurley has ever written. I think the two things that when we look back in 20 years will be kind of regarded the same way that Warren Buffett's letters to his shareholders, the way they're regarded today, are Gurley's blog posts and Amazon's shareholder letters, which are the Amazon shareholder letters. I reread them a lot in the same way I read Buffett and the same way I reread Bill's blog posts. Yeah, so they're great businesses, and usually, anybody can start a marketplace. I could start a ride-hailing app, I bet, in less than 90. I bet it would take me, I don't know, I was going to say 90 minutes. It'll take me 1 day to start a ride-hailing app, okay? But then getting supply and demand on that app, that's the hard thing. That's barriers to scale. And what happened because, you had this huge explosion in venture funding is like the tier one entrepreneurs got funded by the tier one VCs to build marketplaces, and this is Uber, this is whoever else. And then, and this is not to say that somebody who's a number two is tier two or those VCs are tier twos, because some of them are great. But people are like, oh, wow, let's go fund a marketplace there. So these marketplaces are actually kind of natural monopolies, but so many of them, because there was so much funding, ended up with a lot of competitors. And because it is a little bit of a winner take all, winner take most business, you can justify spending and losing almost infinite amounts of money to get to, kind of the brass ring, the gold crown, whatever, the gold medal at the end. And so that has distorted a lot of these businesses. Imagine what a great business Uber would be if it did not have Lyft and Didi and all of these other ride-sharing businesses to contend with. Imagine how much better, DoorDash or Grubhub would be if they didn't have all these food delivery marketplaces to contend with. So I do think that once it sorts itself out and settles either into a stable market structure, and there's all sorts of really cool work and thinking you can do around what the stable level of share is in different markets. They will be great businesses. They will, I think, be sustainable. But it's just because, we're talking about businesses with, incredibly high returns on capital, really high barriers to scale. And those high barriers to scale end up being enduring competitive advantages, because at the end of the day, scale is the most durable competitive advantage. A book that's been very formative to me was written by Bruce Greenwald, who's another Columbia professor. I think it's called Competition Demystified, but he goes through and really statistically assesses how durable different competitive advantages are. And I think Mike Mauboussin has done some work on this too. And ultimately, scale is the most durable competitive advantage.
Awesome, thank you. And we have quite a few questions regarding recurring revenue based on, your podcast with Patrick and some of your tweets about video games. Specifically in your tweets, you spoke about the transition from free to play into monetizing with in-app purchases. So, how recurring are these purchases? And what similarities and differences compared to recurring revenues for SaaS companies are you seeing? And I guess lastly, sorry, what are the trends that you're seeing in regards to in-app purchases now?
Sure. So first, they're not recurring revenue because it's not contractual. I mean, I think at the end of the day, either if we're going to call something recurring, we should be precise, and it is a subscription. So in fact, and in theory, they aren't recurring, but in practice, they are. All these video game companies, they now have economists, they have psychologists, they think about the in-game economy. They can kind of manipulate that in-game economy in different ways. So I think in practice they are really recurring, and I think the point I was trying to make, which clearly did not come through well on Twitter, is software had to transition. They had to get away from the drug of upfront license sales, where you collect $100 upfront and it's super high margin, and instead it's better to collect $20 a year for 5 years, or whatever, $25 a year for 5 years. That's ultimately a more valuable business. And we can go through all the ways that SaaS is better than on-premise. You eliminate, the end of quarter, rush to discount. It's more predictable. There's less piracy. Eliminating piracy might have been in some ways the greatest SaaS value out of all. Look no further than Adobe for the power of that. But so you had to, you used to, when companies would do a SaaS transition, the stocks would implode because their revenues would go down 80% or whatever it is, because you're trading $100 upfront for $20 in year one. The video game companies today that sell $60 games that cost $60 to buy, I think they're all going to have to slowly move towards a free-to-play model. And the reason is, and that means that's risky, and hey, maybe your revenue will go down, maybe it won't. I think there's a way they can manage this transition, and I'll speak to that. But the reason is, what drives value in these virtual economies is persistence. And Eugene Wei wrote a great blog post about status as a service, and that's how all social networks were ultimately driving value. But the reason you spend money on a dance or a skin or a gun or an emoji in a game is at some level for status. We are all, Eugene Wei's quote was, we are all status-seeking monkeys at one level or another. Luxury goods. Everybody is always trying to convey their identity in some way. Even if you hate luxury goods, whatever you are wearing, it is a choice that in some ways confers status upon you. This is, the entire business of fashion and apparel. And it is difficult for virtual goods to have value in a video game when their value gets destroyed every year. So in a game where it's on an every year release cycle, you are destroying the value of those virtual goods annually, so those virtual goods don't have high value. And this is why all the world's biggest video games are free to play. Because in a free to play game where you don't have to come out with a new game every year, you maintain the value of those goods for longer, so people ascribe more value to them. So the revenues from all these in-app purchases, microtransactions, whatever we're going to call them, are significantly higher. And I think there is a way that the video game companies can have their cake and eat it too. And that is kind of migrating, a game I play a lot, Destiny, has gone to a model where your status is never destroyed. You're going to kind of get to keep your emojis and emblems and guns and achievements and swords or whatever else matters to you, dances, all those things matter a lot to me. But every 3 years, you're going to pay $40 for a new version of the game that brings with it new PvE, that's player versus enemy content, and new PvP maps and new items. And I think that is probably a way that they can have their cake and eat it too, and gracefully transition into this model. But it is important, just whenever you get worried about, what's going to happen to that $60 per gamer of revenue, well, all the world's biggest games are free to play. it's just a inherently superior business model. And God forbid you can marry it with paying $40 to $60 every 2 to 3 years, because then it's almost like something that marries the best of free to play and a subscription game like World of Warcraft. But that's what I was kind of trying to get at, and hopefully that is a clearer answer than I was able to give on Twitter.
Oh, and thank you for that clarification. We have a question from Manas about data consumption. So given the increase in data consumption, is this, this is a watershed moment for edge computing companies and content delivery networks, or do you think the sector is going to have a lot of consolidation and then the weaker players will be gone?
I don't think it's a watershed moment for CDNs. Look, I mean, at some point, no later than 18 to 24 months when we have a vaccine, the world will go back to normal. It seems very likely to me we'll have a vaccine. Obviously, there's an implicit assumption in that. All the big cloud companies have their own CDNs. I don't really see this as a true watershed moment for CDNs. Something interesting that I think, and this is just kind of a natural extension of the way cloud computing was already evolving. Edge computing, like edge computing, like this is going to be an edge server. It's going to drive my personal AI, but we're also going to need latency is a speed of light problem. It cannot be solved since speed of light is kind of a fundamental physics constraint that exists in the universe. We're never going to solve the speed of light problem, so latency is always going to be with it. So you're going to continuously be pushing, compute closer and closer to users. The cloud companies are doing this. Google, Amazon, and Azure. They're always, trying to push compute out. They have the huge. You almost have this tributary system. You have the huge core center data centers, and then you have more distributed computing that's less powerful in these kind of concentric circles. Something that I think is fascinating, and I don't think it's going to be accelerated as a result of this, but this clearly Amazon is correct with their Amazon Go store, and you're going to have a lot more technology in every store. And when you walk into a store in 5 or 10 years, it's going to identify you by your face. It's going to pull up a profile. It's going to know everything about you. What were the last things you bought there? You're going to get personalized advertisements in your AR glasses as you walk through the aisles. Shrink is going to be a thing of the past. You're going to pay by face. You're just going to walk out of the store. All of that has already happened. We just need like another, 2 to 4 revs of Moore's law and no more. But one thing that is interesting about that is that means there's going to be a lot of compute power in those stores, because you're not going to be able to go to the cloud to do all of that in real time, and it won't be efficient to do it in the cloud. So you're going to have a lot of compute power in those stores. A lot of the companies that are deploying, AI-based loss prevention and checkout technologies in stores today, they'll put in, a local cluster of NVIDIA GPUs in the store to do this. But that means, part of the cloud story was driving up utilization, which drives down compute. And this means that you're going to have these huge, basically data centers, and not huge, you're going to have very small edge-focused data centers in every store. And what can you do with that compute power? And luckily that will be those stores. Not a lot of people shop at night, but people do use the internet at night. So is that kind of where edge compute is going to go, to stores and restaurants that have a lot of local compute power to power the AI algorithms that they use to deliver personalized in-store stopping experiences? That is something that I am thinking a lot about. And then I think eventually we will all be able to, right now you can, if you have a powerful enough GPU, if you're a gamer like me, you could actually earn money the entire time you're not playing a game on your gaming laptop or your gaming desktop by mining cryptocurrency. I think in the future, you are going to be able to, let AWS, Azure, or Google use the compute power on every computer and computing device that you own while you're not there. And there will be some algorithm about, what they're willing to pay relative to what electricity costs you, and you'll make a little bit of money. And we will all, eventually every processor in the world will be utilized 80 to 85% of the time. This is utilized, I'm not going to tell everybody what my Apple screen time report is, but I spend way more time than I should on my iPhone. But like at most, I'm using 20% of the cycles on this super powerful ARM CPU in here. Eventually, all computing devices will be utilized 100% of the time, and AWS, Google, and Azure will pay you money for the right to rent this. So I think that'll be something really cool, and those are that's kind of the waterfall I see for edge computing. Stores and restaurants first, followed by ultimately our own devices.
It sounds almost like an episode of Silicon Valley with Pied Piper.
Yes.
I think we have time for two more. So quickly, we'll just pivot into looking at VC. And given the large amount of money in VC and the fallout from the Vision Fund, do you think that there's anything broken with the current VC model?
Yeah, I don't think anything is broken at all with the current VC model. I mean, I do think the Vision Fund model broke. Like, you cannot create winners with capital. At some level, that was the fundamental underlying thesis of the Vision Fund, and it looks like it was wrong. Now, maybe in a different world where, the Vision Fund had gone slower and been more mindful of vintage risk and had made different investment decisions, they could have. But I don't think anyone is going to repeat that experiment in the near future. But the Vision Fund did have a very distorting negative effect on the ecosystem. You also had, I think, a lot of people who decided they needed to be in venture, random hedge funds trying to, outbid, and they thought there's a lot of thinking you needed logos. So you had the logos. There's this crazy thing in 2018 and 2019 where you had the Vision Fund, but on top of that, you had new players who wanted to get into the business and either thought they could get into the business by either outbidding the Vision Fund or marking up the Vision Fund. Whoopsie daisy. Look, I've made a lot of horrible venture mistakes. I was lucky enough to make those mistakes in a more forgiving environment in 2013, 2014, 2015. But there are a lot of, if you're a public equity investor, there are a lot of lessons you need to learn when you go to venture. A mistake, and I'm not going to say names, but a mistake, an astonishing number of sophisticated public equity market participants made was, they get this forecast from this, venture-funded SaaS company doing a late-stage financing, and they look at the 2023 number for revenue, and then they do EV to sales for that. And then they'd compare it to EV to sales for the best public comps. They'd be like, wow, the venture company is so cheap. I'm getting at this at, half the value of the public comp, or, in some cases, less than half. Well, venture forecasts are not public equity forecasts. If you miss a forecast as a public equity company, there are horrible consequences. Your stock goes down a lot. If you're the CEO or CFO, you might get fired. It is accepted in venture that all companies are going to miss. 80% of companies miss the quarter during which they are fundraising. 90% of them, I think, miss the first year estimate, often by a huge amount. So you're comparing a public equity forecast that's been heavily de-risked, and I'm just going to make it up, but let's say the public equity SaaS forecast goes 40% revenue growth, 20% revenue growth, 15% revenue growth. And you're looking at a venture forecast that goes 100, 90, 80. Well, probably something should look wrong about 190, 80, but the real number is they're not going to grow 100. they're going to grow 70. And if they weren't burning cash, they'd be growing 40. So like the first thing you have to do is really haircut the numbers. And when you compound that out, it generally means like the year 3 actual for your average venture funded company is probably something like 50 to maybe even 40% of what's in their model. So it's a massive miss when you compound it out. And then these aren't public companies that care about dilution. Instead of having annual share dilution of, whatever it is, 5%, 8% if you're in a new, more aggressive public equity SaaS company, or, shrinkage if you're in a more mature company like Microsoft that's shrinking its share count every year, instead the share count's going to grow 10 to 15% a year. And so if you compound that out 3 years, you have revenues that are 40 to 50% of what you underwrote. And the share count is, 45 to 50% higher, which means the true EV to sales, if you're looking at that kind of silly metric, is you're off by a factor of 3. And so I think the good news for venture is everybody has now learned all those lessons. A lot of mistakes have been made. I think the world is sorting itself out. It doesn't look like we're going to have a Vision Fund 2, which really works to the disadvantage of kind of the best VCs. The best VCs, returns are more persistent in venture than any other, for the top decile of venture than any other asset class. And the reason for that is the best entrepreneurs want the stamp of approval from the best VCs. So they go to the best VCs first. So the best VCs, there's all this path dependency, and it's really tough to break into that club. You need to get really lucky because the best VCs always see the best deals. So everybody else is getting the deals that they are passing on. And this is why returns are so persistent for, the benchmarks, the Sequoias, the General Catalysts, the Valors, the, whoever of the world. I guess Valor's more of a growth equity firm. So that I think the world is sorting itself out and returning to normal in venture. But capital, let me just finish. Yeah. Capital scarcity works to the advantage of good VCs and good entrepreneurs. Capital abundance works to the advantage of bad entrepreneurs and less established VCs.
And thank you so much. I want to be respectful of your time, but very quickly, a lot of people have been asking, what are your favorite books and podcasts? We have a lot of people on this call who only know banking, for example, or people like myself who come from, IT infrastructure and vendor selection. So how can we learn about the other side that we don't know?
Yeah, gosh, favorite books. I love Hemingway, Tolstoy, and Dostoevsky. But I think as a technology investor, we're talking about two things, about technology, what's important for technology, and then what's important for investing. And if you're going to be a technology investor, both of these are important. And I'm embarrassed to say, apart from Patrick's podcast, I'm generally a reader, not a listener. So technology-wise, I actually think if you're going to be in tech at all, as an investor or an operator, it is critical to read science fiction. So much of what has happened in the world over the last 20 and 30 years, was written about eloquently 40, 50 years ago. It's amazing how many things Isaac Asimov predicted. So I think it's really critical to actually read science fiction because I think it will open your mind to what a wide range of possibilities there are for the future. In some cases, it can help you predict and understand the future. I always think about that great, I believe it's Alan Kay quote, the best way I know to predict the future is to invent the future. I'm not smart enough to invent the future, so I have to spend a lot of time thinking about different scenarios. But yeah, everybody should read Dune. Everybody should read Isaac Asimov's Foundation trilogy. Everybody should read the Culture series by Ian Banks, which starts with Consider Phlebas, which is a reference to the T.S. Eliot poem, The Wasteland. But The Culture is, in some ways, I think, one of the most powerful visions for the future I've ever read. Um, everybody should read Hyperion. So science fiction, I think, is really, really important and has been important to me personally. It's been important to me as an investor. It's important to me as someone who tries to understand technology. And I think it's one reason I have a lot of close relationships with people who are CEOs or founders or VCs. And I think one reason I've been able to bond with them is I don't really watch sports. I play video games, I read science fiction. There's no nerdy reference they can make that I can't immediately at least like nerd compete with them, if not out nerd them. I read science fiction, I think, is very important if you're going to be in technology. As an investor, I think it's really important in terms of books to read. You know, you want to be steeped in all of the the great books about investing. You want to read and reread Warren Buffett's shareholders' letters. You want to, I often joke in the English language, Shakespeare had 90% of the great quotes. Churchill had the other 10%. In investing, it's like Warren Buffett has the overwhelming majority, then Peter Lynch, who, I'm lucky enough to have spent a lot of time with him, and he's a truly great investor from whom I've learned a lot, along with a couple of other fund managers at Fidelity who are very important mentors to me. But for investing, in addition to reading everything about investing and the mechanics of it, I would encourage you to read books that help you be comfortable with being wrong, with managing your ego. Because when I used to interview for Fidelity, and I would interview college kids or MBAs like yourselves, and I think I talked about this a little bit on the first podcast, but just in almost any profession other than professional investing, you can multiply intellect times work ethic times charisma, modify it by luck, which is the most important variable, and get to a band of outcomes. That equation does not work at all as an investor, because the dark matter of being an investor is, can you be rational when you are wrong? All of our lives, we're taught that being wrong is shameful. And so a lot of people find it very difficult to be rational when they are wrong. So and I'm going to recommend a book, find ways to deal with your own ego. Because I think one thing that hopefully comes through when you talk to investors is a lot of good investors are actually they have a lot of intellectual humility, because I think having that is absolutely important to being a good investor. So one book that I have read many times in my life, and it's a kind of somewhere between I guess it's a fantasy novel, a little bit of science fiction. It's Ursula Le Guin's A Wizard of Earthsea. And on the one hand, it's kind of a classic Bildungsroman, Roman, a coming of age story. But on the other hand, it's all about how does the protagonist learn to deal with his own ego. And it is amazing to me, anytime I go through a hard time in my life, and I've gone through a lot of hard times, personal and professional. I mean, look, I've been very lucky as an American, so it's not like I've had hard times the way some people in the world have, but I've gone through hard times, particularly many hard times professionally. And I always reread that book, and I take something different away from it each time. But that book has helped me a lot as an investor, kind of learn to deal with my own ego and become more and more rational when I am wrong. And there was an exchange on Twitter about this. I think there's a book maybe by Carol Dweck, The Growth Mindset, that Satya Nadella really liked. But just looking at mistakes, looking at being wrong as learning. You actually, by definition, are not learning if you're not wrong. The process of learning is destroying beliefs and knowledge and systems of thinking that you have in your mind and replacing them with different kind of belief systems. So if you can view being wrong as learning, I think it's a really powerful step as an investor. Reading A Wizard of Earthsea has helped me a lot with that. But just going back to investing as a search for truth, and it's a competition for who can have the most accurate possible understanding of the current world, which a lot of times, to quote Matt Kohler, is all you need to invest. Just if you can see the present more accurately, you don't even need to see the future. You kind of saw the future first. But if investing is a search for truth, then I think having kind of as small an ego as possible, and being really open to being wrong and learning is really important. And this is why there's no right or wrong investment philosophy. You have to find an investment philosophy that meshes well with your own particular emotional makeup, and one that will help you be rational when you're wrong. For some people, that's stop losses. For other people, it's deep value. For other people, it's growth investing. But it has to be the right philosophy for you as an investor. And this lastly, I'd say, I'm very sorry, but just since you're all MBA students, I would say be open-minded about investing philosophies. Some of the greatest investors I know started with a very different philosophy of investing than they ended with. So be very open to different philosophies, because it may be the one that appeals to you intellectually, doesn't work well with your own emotional makeup. It doesn't help you be rational when you're wrong, and stay humble and look at being wrong as learning. So sorry, that was advice that was unasked for, but hopefully it was helpful to someone.
Great. Gavin, thank you very much for your time. I know it's we don't want to take too much of your time. Again, this has been a fantastic conversation, and we'll follow up with a email about your favorite books, because I think a lot of people would be interested in the other books I'm sure you've read and are thoughtful about that you didn't mention.
Sure, I'm happy to send a book list, and like I said, loads of respect for the investment program at Columbia. So many great investors have come out of there. It was been a dream for me for a long time to actually audit the class. Now that I've finally met Mike Mauboussin and he knows who I am, maybe he'd let me do that. Actually, I'm super honored that you guys wanted to do this. And, anybody who listened, please consider me a friend. You can always reach out to me. David has my email. Hopefully a lot of good things come out of this, and, good friendships and relationships. And best of luck to everybody. It was a lot of fun. Good questions. Thanks.
Thank you very much. We'll do a virtual clap, but.
All right. Thanks.
Okay. Thank you, everyone.
Thanks a lot. Bye-bye.
Bye-bye.